Hi, I'm Tyler Hosier, a risk management examiner in the Omaha, Nebraska field office.
And I'm Chastity DeShock, a risk management examiner in the Fargo, North Dakota field office.
In the basic analysis module, we discussed a general process for evaluating lower risk municipal bonds. If a bond has complex or unique features, or appears to have higher credit risk characteristics, then some form of expanded analysis is warranted. The expanded analysis process should evaluate these features or characteristics to ensure the bond meets the bank's creditworthiness standards. In this module, we will discuss an expanded pre-purchase credit analysis and ongoing credit monitoring framework for municipal bonds. The framework presented in this module is for example purposes only, as the FDIC expects industry practices will continue to evolve. It is not intended to be all-inclusive, nor is it appropriate for all banks. Each bank should implement a framework consistent with the complexity of the board's approved investment activities.
The expanded credit risk analysis process should consider the same factors as the basic analysis, but in greater detail. The extent of the expanded analysis will be determined based on the results of the basic analysis. Expanded analysis may be required at the time of purchase or periodically thereafter. Expanded analysis of the location and type of issuance is not necessary, as these elements were reviewed in their entirety during the bank's basic pre-purchase analysis. For the remainder of this module, we will discuss expanded credit risk analysis factors, focusing on economic conditions, the financial condition and fiscal responsibility of the obligor, and rating agency reports. Let's begin our expanded pre-purchase analysis discussion with economic conditions.
Economic conditions are a vital component of credit analysis for municipal bonds. There are several additional areas to consider when reviewing the issuer's local economy on an expanded basis. First, reviewing employer trends typically includes an analysis of the diversity and stability of the employment base. Concentrations by taxpayer or industry can result in a more volatile employer base and local economy. This is especially true if employers are centered in cyclical industries, such as manufacturing, hospitality, agriculture, and energy. Second, assessing labor trends includes a review of job creation, employment, and per capita income levels. A decline in any or all of these metrics may serve as early indicators of potential economic stress. Next, analyzing property trends involves reviewing assessed and market values, building permit activity, and occupancy rates. Changes in property values have a significant impact on tax receipts, while building and occupancy levels can be used to gauge the health of the local real estate market. The 2008 housing crisis and related declines in property values were especially painful for many areas of the nation and adversely impacted the financial condition of many municipalities. And finally, other factors to consider include an economy's size and growth, competition, and population trends.
Tyler, could you tell us more about these other factors?
Sure, Chastity. Some small or less diverse municipal economies may be more vulnerable to economic downturns, or may lack sustainable economic growth. Competition relates to a municipality's ability to offer employers a favorable business environment, which aids in job creation. And population trends are important, as a decline can be problematic for a municipality as the tax base decreases relative to the issuer's debt. Economic analysis should not be confined to the issuer's local economy. If the municipality relies heavily on state or federal government payments to operate, this reliance should be considered. Now let's discuss the analysis of municipal financial statements.
A common method for evaluating the financial condition of municipal obligors is to perform ratio analysis. A table, such as the one presented here, is a possible tool for this analysis. Other formats or reporting mechanisms may be more appropriate, depending upon the level of detail necessary for proper assessment of municipal portfolio risk. This table lists potentially useful ratios for reviewing a general obligation bond. Management may determine that other ratios are more useful and appropriate. The analysis used should be tailored to the risk profile of the bank's municipal portfolio. We discussed the two leverage-related ratios, debt per capita and debt to assessed value, in the basic analysis module. In addition to leverage, the reviewer could also consider the other ratios in the table related to the obligor's liquidity, revenue concentration, repayment capacity, and debt burden. Each ratio should be compared to the bank's internal policy guidelines to determine if the bond meets its credit criteria. When the expanded analysis of the obligor's financial condition uncovers weaknesses, third-party credit enhancement may mitigate the risk. Similar to a commercial loan guarantee, the credit enhancement supports the timely payment of principal and interest. Common forms of enhancements include bond insurance, bank letters of credit, and state or federal credit programs. The strength of the enhancement provider should be considered.
Chastity, you mentioned a tool for general obligation bonds. Are there factors related to revenue obligation bonds that management should consider?
Yes, Tyler, a similar tool could be used to review revenue obligation bonds. Financial review of revenue obligation bond issuers is similar to commercial credit analysis, especially for non-essential purpose revenue obligation and industrial development bonds. In many cases, a bank's commercial credit assessment framework could be applied to the revenue obligation bond analysis, with only minor adjustments. An example of a potential framework for revenue obligation bond analysis is presented in this table. We discuss capacity and protection in the basic analysis module. When assessing leverage and liquidity, ratios such as debt to capital and cash to total debt may be used. Revenue concentration and competition may also be assessed. Each ratio should be compared to the bank's internal policy guidelines to determine if the bond meets its credit criteria. If financial weaknesses are identified during this analysis, any mitigating factors should be considered.
Assessing fiscal responsibility of the municipality is similar to assessing the character of a loan customer. Although this is one of the most qualitative and challenging areas to assess, a municipality's ineffective management and governance can impact performance and increase credit risk. We discuss budget, audit, and disclosure practices in the basic analysis module. Expanded analysis includes 3 additional areas to review. The first area is capital planning and debt management. Ideally, an obligor should have a multi-year capital improvement plan, including reasonable levels of projected debt issuance. Without proper planning, capital spending may negatively impact a municipality's debt levels. The second area is operating flexibility. Many municipalities have statutory limits on the tax levies they can assess, which can restrict their ability to raise revenue. And finally, the third area is labor relations. Compensation and benefits frequently comprise a significant portion of a municipality's budget and can affect an obligor's long-term financial condition.
Rating agency reports can serve as one component of the overall expanded credit risk analysis. They are also an effective tool summarizing the obligor's local economic conditions, financial condition, and fiscal responsibility. External ratings for municipal bonds are not always updated on a timely basis after issuance and can vary among rating agencies. As a result, management should consider the timeliness of the reports, understand the rating methodologies, and investigate any rating differences. Credit rating median reports present median or midpoint ratios as well as financial and tax-based information for municipalities, organized by credit rating band. They can be useful when setting internal policy guidelines and when assessing the credit risk associated with non-rated bonds and bonds with stale ratings. For example, management may compare financial or performance ratios of a specific bond to the applicable medians. The median reports are derived only from that rating agency's universe of rated bonds. Therefore, the ratios and data may not reflect industry medians. Additional information provided by the rating agencies that can assist in assessing individual and portfolio credit risk includes sector outlook reports and rating methodology reports. Sector outlook reports provide that agency's performance expectations for each sector based on their analysis of median data. The reports provide an aggregate view of financial performance, fiscal responsibility trends, and economic conditions impacting that sector. Rating methodology reports describe the credit risk assessment framework used by each rating agency. Bank management can use the reports to formulate the bank's own credit risk assessment framework and to understand why there may be differences in ratings among the rating agencies. This concludes the discussion of expanded pre-purchase analysis, and now Tyler is going to discuss expanded ongoing monitoring expectations.
Expanded ongoing monitoring should be completed at least annually and documented. It may cover economic conditions and the obligor's financial condition and fiscal responsibility. Interim analysis may be necessary in certain situations, such as a severe ratings downgrade or a technical default. Bonds where higher risk characteristics are identified should be subject to some form of expanded ongoing monitoring. Certain bonds within the portfolio will almost always require expanded analysis. Examples include industrial development bonds, non-essential purpose revenue obligation bonds, those issued by obligors located outside the bank's defined geographic area, and those located in distressed markets. Bonds may move between basic and expanded ongoing monitoring as risk characteristics change. The ongoing monitoring procedure should be expanded as the bond's risk increases. Monitoring procedures can become more basic as the bond's risk level decreases. The depth of the analysis and monitoring procedures should be consistent with the bond's risk profile.
As discussed in detail in the Basic Analysis module, additional resources are available that may assist in the overall risk management process. The EMA website provides free access to official disclosures, trade data, credit ratings, and educational materials. The issuers, state auditors, and state attorneys general may be contacted to obtain additional information on municipal entities. Other third parties such as securities brokers, correspondent banks, and rating agencies may be a source of information.
To summarize the key points of this module, expanded pre-purchase analysis and ongoing monitoring should be performed when bonds with complex, unique, or higher risk characteristics are identified during the basic credit risk assessment. The expanded credit risk analysis process should consider the same factors as the basic analysis, including the economic conditions, financial condition, and fiscal responsibility of the obligor. Expanded economic analysis may involve reviewing employer, labor, and property trends, as well as other economic factors.
Ratio analysis is a common method for evaluating the financial condition of municipal obligors. We provided examples of possible ratios for assessing both general obligation and revenue obligation bonds. In many cases, a bank's commercial credit assessment framework could be applied to the revenue obligation bond analysis with only minor adjustments.
Assessing fiscal responsibility is similar to assessing the character of a loan customer and may include reviews of capital planning and debt management, operating flexibility, and labor relations.